Welcome to Momentum Monday. Today is May 15, 2022. Howard, are you excited about Game 7 of the Suns and the Mavericks?
Yeah, I mean, it's stressful only because I want the actually Suns to win. If I didn't care, it would be fun, but they just have been kind of hit or miss. And then I watch my Leafs lose Game 7. So let's get to it.
Yeah, I mean, so last week, basically, we saw a pretty increase in correlations, pretty high increase in correlations among stocks. Earlier in the week, most stocks sold off, and then later in the week, they kind of bounced together. So I think we might be in the midst of a bear market bounce. We saw that reversal candle on Thursday, and then a follow through candle on Friday. So sentiment appears to have changed, at least in the short term, and I wouldn't be surprised if we have like a slight gap up tomorrow, and just as the indices try to test their declining 20-day. What are you seeing?
Well, it's a bear market, right? So I wouldn't be surprised to see a 90% down day after what we had Friday, right? Like crypto.
Yeah, it's possible, yeah.
Yeah, so it's a bear market. So if we got the 200-day moving average of the Qs and the S&P, I don't know if you can pull those up. I mean, look where we should be. Is that the 200-day right there?
Yeah, it's the black one, yeah.
Yeah, so we are 20% below the 200 days. So yeah, I mean, that's a lot. So nothing good happens other than a bounce here. It's going to take a lot of time. Where's the S&P's 200-day? A little closer.
The S&P, yeah, it's a little bit closer, but still,
10% below, right? And you hit a lot of the technical people that I really like, who have, are more short-term traders, talk about not the Fibonacci line. What's the line that Brian Shannon uses?
It's the VWAP from the 2020.
There is a VWAP line at the 380s.
From the COVID lows, yeah. It was 385, yeah. 385, it bounced from there.
Yeah, there a lot of the machines are set up to buy here blindly. And it works.
Yeah, probably it's going to test 410.
So I think you see some more rally, but at the same time, we're vulnerable here. When you're below the 200-day for this long and this fast, and the sentiment is this weird, and the Fed's not going to help, right? There's a difference. And when Trump was president, you knew that he would flinch, right? And he would yell at somebody, and whether it was the government shutting down and him flinching, anytime the market, because he bet his whole candidacy on the stock market, right? This government does not give a shit about the stock market, and the far left would like to see it burn. So you've got half the country indifferent, and by the way, half the country probably should be indifferent because the economy isn't the stock market, right? So I don't know. I just think I don't like making big bets when you're trading below the 200-day moving average. Sentiment's bad. Look at the last 2 weeks of the economists is like, the Fed failed, which is bullshit. The Fed wanted to get inflation going. They were more worried about stagflation and deflation, right? So the Fed didn't fail. That was their plan. And then what China is getting wrong, we don't know what China wants to do. Like fucking, it's The Economist, which I like reading. So it's like the headlines are all bearish. You had complete panic selling in like Coinbase, Robinhood, the broker. They were all trading at cash value, right? Coinbase prints money. They may not be growing, but and their margins may be shrinking, but prints money. So those feel like some crescendos, right? But valuations are still high. If you go to Snowflake or Zoom, it's not like they're cheap, right? These are still trading at like banana time multiples in a market that we know multiples are shrinking even for the best companies, Cloudflare, Snowflake, Datadog. So they've all given up. So you've got to, if you want to be in the market and you don't want to trade, you text off the plate for now. So you've got to go look at like healthcare, and those were XLV rolled over. So if you look at XLV, it's bouncing. So this may be a better candidate for a bounce. The miners, XME, I think, may be a better candidate for a bounce. Alcoa may be a better candidate for a bounce. So yeah, I got to learn, if we're in a bear market and you want to truly trade, you want to focus on stuff in an uptrend. And that's energy, mining, agriculture, move.
It's
I don't want to waste time.
Only energy is the only one left at this point, Howard.
No, but you know what I mean? There's probably still be some pin action in the ags because of inflation. I'm not saying they're great trades. I'm just saying I'm tired of trying to trade, broken stocks. Like it's not a good, it's just not a good idea. What else? I saw McKesson, where's United, MCK, like there's some stocks that are like, but again, with the markets below the 200-day moving average, I think you have to just play tremendous defense. Like, what are you thinking short term? Like, were you putting money to work last week?
Yeah, definitely. Thursday, Friday, definitely flip long, mostly intraday, but some short-term swings as well. Like, I mean, I like the action in AMD. I think they'll test at least 100. Definitely one of the stronger tech stocks, very strong earnings, accelerating growth. And you can definitely see intraday when the Qs were selling off how the AMD was kind of holding. There were definitely people, institutions acquiring it. So yeah, it's looking ugly in the long term, and the overall weakness in the market is gonna keep a lid on it. But one of the probably the strongest semi probably is not going to be affected by crypto as much as Nvidia is right now. So I mean, I'm strictly talking really short term, either intraday or really like 1 to 3 day swing. Like I'm not really looking anything beyond that on the long side or on the short side at this point.
Yeah. Well, I just think there's so much down. There was 1 trillion lost in crypto last week. Gold's not working.
Yeah. Gold and silver. Yeah.
Yeah. So the dollar's romping, which is just not good. So it's romping, which is great if I'm in cash. Like I'm in cash, but I know this is not going to last. So this is this chart I'm watching the most. This is the treasuries. We need to see some kind of bottom put in here so that people at least will want to carry stocks overnight. We need to feel like, what is it from rates being higher 2 years from now versus 3 months from now? And this move is just so fast and cuts so deep. And people are going to get their April statements any day.
Yeah,
and it's like the worst bond market ever. So rich people haven't even gotten their April statements, and they're going to be in for a shock. Okay. And then they're going to get their May statements, and it's going to be worse. You know what I mean? Like people are in a recession. Like rich people are cutting things out. And we'll go to games and we'll go eat every night out, but we're not going to buy that stupid stuff anymore. Right.
Well, they say that the market is 6 months ahead of the economy, and the jobs numbers are a lagging indicator. So all those good news that we're hearing right now, they may be just lagging.
Right. And biotech, good one that you pulled up. So I was listening to some smart I was listening to All In podcasts, and Friedberg, who's actually very smart around biotech, is like, these companies are out of money in 2 years. Like they all burn hundreds of millions of dollars a year. So this isn't like a sell-off into support. This is a sell-off before the sell-off potentially, right? Because these companies are walking dead. If they can't raise money, if they can't raise money in these markets, this is not a pullback. This is the beginning of the end, right? Because so this is risk off right now. Like, so that's a sector that's like over my pay grade. In a bull market, in a bear market, anything could go wrong here.
Yeah, this is something I tweeted earlier in the week that XBI, the biotech ETF, they went below their COVID lows from March 2020, but
that's because of burn. They're burning money, and now there's no money to be raised. And
I also mentioned that the 10-year yield back in March 2020 was at all-time low, like 0.3%. And nowadays it's 10 times higher. It's almost 3%.
I have a lot of smart traders that are.
I think I lost you, Howard. Either mine or your internet connection is a bit slow. Okay. Then
day is that people like me stop writing checks. Again, I don't hold up to anything, but I mean, I stopped writing checks 14, 15 months ago because of valuation. Now you're going to have all these companies that they're kind of floundering slash overpriced slash employees are underwater in their stock. Plus, right? Plus, you know, should I work from home? Do I supposed to go into the office? Oil's expensive. You know, like, there's a lot of problems, and they're all just ganging up at once. You know, again, that's how bottoms are created, but we're not in a rate. We're not, the Fed's not on our side right now. And it's been a Fed driven market for, I don't know, 12, 13 years. So that's the big issue. The Fed's not on our side. The second thing on our side is people have got used to being able to raise money, and no matter what predicament they're in, and that's going to change. And then the third thing is no one can afford anything. And people are on, so the question is, do you do the, like, let's look at Capital One. Let's look at Capital One, for example.
Okay.
So these are starting to break down. So are we at the beginning of a credit crisis? American Express, let's see where American Express is. Like, these were holding up well until a month ago.
Yeah. And that UPST, they had a really bad report. I mean, they're basically in the...
Yeah, but that was always just like a simple fintech company, and it's still got a great valuation. Still, what is it? What's the valuation?
Okay, let me go back. 3 billion.
Yeah, it's still a $3 billion company, and that's where it was 2 years ago. So it's not, this is just air coming out of, these things aren't going to zero, but they were just expensive. You know, PayPal, look at PayPal, it's trying at 2 times sales. That was one I'm looking at, like 20 billion in cash. So right now, like, there's opportunities. They're throwing everything out together. And when that happens, when the correlations go to 1, as you say, Ivan, is when I make calls and talk to friends in the industry and see which companies shouldn't be down 80%. There's a difference between Zoom and Peloton. There just is. There's a difference between Datadog and some random software company. So now you've got to differentiate. And the good news is, for people that never got carried away in this, there are 100 companies out there in the software space. They're going to be 10 times higher in 20 years. So you've got to go, you know, do the work and build the list. But that, you know, this Zoom pullback, for example, all the charts are starting to look the same. So the question is, we're probably 70 to 80% of the way in software and in tech to some kind of bottom. But that last 50% down, like if they get halved again, is brutal, is really brutal. And you've got to know, you've really got to know your individual companies if you're going to step up here. So I don't know. I think people just, with stuff this below the 200-day moving average, I expect to see a bangs. What I'm worried about is if we don't. And so I'm not brave enough to like bet the farm down here. It sounds like you're doing the same.
Yeah, I mean, definitely trading small and short term, just protecting capital.
Right.
So, but you've been nibbling here and there, right?
Last week I'm nibbling, but I'm trading. Like, I mean, Coinbase, that was just too early, but then trading my way around it to get out of it, you know, and it worked a little bit. You bring down your average cost. Like the stocks that I really liked just really gave up. And so this is just,
yeah, even Apple broke down. I mean, with all those closures in China, they're definitely probably going to impact.
The good news is they are so well positioned with the M1 chip, with their wallet, and with, well, and they're thinking past the App Store already. So I just think, and their cash. And the fact that they're getting tough on their employees, they got to come back to the office. So they're doing, and they were starting to move to Taiwan. So I'm saying at least they've had it, because they have the capital and Tim Cook running it, and they're somewhat predictable, they at least for the last 2 years during COVID have been preparing for the next thing, right? So, but can it go to 90 or 80? Absolutely, because that's what will bring the indexes down, right? If we go look at the NASDAQ, why can't the NASDAQ be at 8,000 again?
The Nasdaq Composite, let's put
it. Or the QQQ. Why can't it be at 8,000? I mean, so, you know, to me, you've got to, and that would be mostly Apple and Microsoft just making up, right? But cloud spending could drop. Like cloud's going to be here for a long time, but cloud spending could finally drop. So that's Amazon, that's Google.
Microsoft, yeah.
Yeah, Microsoft. So I got to think as people tighten and as traffic drops on the internet and people go back to work, cloud just demand for cloud is, and now that may be priced in. The good news is that may starting to be priced in. So I'm just not smart enough for, and I'm too risk averse to like bet the farm at these levels. So that's how I'm thinking about it.
Yeah, makes sense.
I mean, in terms of like stocks that look good, Merck look pretty good. Again,
Yeah,
I'm going to
slow
double my
mover. I mean,
money.
it's nothing really that excites me at this point, but yeah.
Right. So it's just different betas. If you have to put money to work, there's not enough of these, right? And the pull of the market lower is just it's hard for like single stocks to really exit. It's very hard to pick stocks in a bull market, in a bear market, super hard. So doing less. All right, have a great week, everybody. Thanks.
All right, enjoy the game, Howard.
Thanks.
Bye.